We're analyzing Zoetis, stock ticker ZTS, to see if its market price is a fair value. We're using the Select 6 analysis to look at the most telling financial metrics before estimating an intrinsic value for Zoetis. Then we're giving a final rating to the business. There will be a key bonus metric along the way that just might be the tipping point when analyzing Zoetis for your portfolio. Before we get into these valuable metrics, let's understand their stock performance. Right now, Zoetis trades for $176.90 per share. In the last year, their stock price is up 2.8%. This is outperforming the S&P 500. In the last 5 years, Zoetis is compounding at just under 17% annually. Going back to Zoetis' time as a public business, in the past 10 years, the company has compounded at about 18% annually. Zoetis also pays a dividend. Right now, Zoetis has a 0.78% dividend yield. Their average dividend yield throughout this time frame is in addition to their compounded annual returns. Zoetis trades just a few dollars below their 52-week high. The company's up more than $50 from their 52-week low. About 1% of their shares are sold short. Zoetis is a very large business. They have an $83 billion market cap. But why should we be paying close attention to Zoetis? Zoetis sells anti-infectives, vaccines, parasiticides, diagnostics, and other health products for animals. The firm earns slightly less than half of its total revenue from production animals, which include cattle, pigs, poultry, and so on, and more than half from companion animals, dogs, horses, and cats. Products make up the other half. Its U.S. business is heavily skewed toward companion animals, while its international business is slightly skewed toward production animals. The firm has the largest market share in the industry and was previously Pfizer's animal health unit. Starting with metric number 1, we want their average return on capital in the last 5 years to be above 14%. There are two key reasons for this. The average publicly listed business earns about a 7% return on capital. Over the long run, over the course of decades, a stock is likely to return approximately what its underlying business returns. These business returns will be captured here by return on capital. Looking for a benchmark that's twice as good as average potentially allows us to build in some margin of safety for ourselves based off the overall quality of the business. Zoetis has increased their returns on capital throughout this time. Their lowest returns on capital were just about 20% in 2020. Averaged out in these last 5 years, Zoetis earns about 22% returns on capital in a given year. This is nearly 3 times better than a typical business. This is a strong check on metric number 1 for the company. Metric number 2, we're looking for revenue, net income, and free cash flow growth in the last 5 years. This metric is all or nothing. All 3 have to be up for this to be a check. During this time, Zoetis has moderately grown their revenues by about 39%. Their net incomes have increased by 48%. However, the company's free cash flows have declined by about 9%. Because their free cash flows are down, this is an X on metric number 2. It's not ideal to see declines in free cash flow, although they can be lumpy year to year. That's why we'll be taking an average later on in our analysis. Free cash flow is the lifeblood of any business, so it's not great to see that it's down. Ultimately, a business's abilities to produce free cash flows now and until Judgment Day, discounted back by some reasonable interest rate, is what that business will be worth. We'll be using that exact method later in our video to come to an estimate of Zoetis' fair intrinsic value. Metric number 3, we're taking the perspective of an individual shareholder by looking for earnings per share growth in the last 5 years for Zoetis. We just learned that the company's earnings are up during this time, and during this period, Zoetis has bought back about 3% of their shares outstanding. With their slight share buybacks and their earnings growth, this is a check on metric number 3 for the business. Metric number 4, we're looking for free cash flow per share growth in the last 5 years. As Zoetis' free cash flows have declined by 9% over this time, their 3% share buybacks are going to be outpaced by their declines in their free cash flows. This is an X on metric number 4 as the business's free cash flow per share has declined. Recapping where we stand currently, we're split evenly. We have 2 checks and 2 X's through our first 4 metrics for Zoetis. Metric number 5, we're analyzing the business's debt. During economic downturns, it's overly levered businesses that are likely at the greatest risk of poor outcomes. We want their net debt, which is their total debt minus their cash and their short-term investments, to be below the amount of free cash flow the business has produced in their last 5 years. Currently, Zoetis has about $4.6 billion in net debt, and in the last 5 years, the company has produced $7.5 billion worth of free cash flow. Even with their declines in their free cash flow, they'd be able to comfortably support their debt position throughout this time, and they'd be able to support this position with their current free cash flows. This is a check on metric number 5, as it looks like Zoetis is strongly cash flow generative relative to the debt that they're employing. So far through our first 5 metrics, we've got 3 checks and 2 X's for Zoetis. The big metric of them all, metric number 6, we want their average free cash flow to their total enterprise value to give us a yield that's above 5%. If this is the case, this will give a slight risk premium to the yield of the 10-year treasury, and it may offer a reasonable starting point for a fair value of Zoetis. Zoetis currently has an $87.5 billion total enterprise value. This takes into account both their market cap and their net debt position. It gives a perspective of the company that's more similar to as if Zoetis were a private business. In their last 5 years, Zoetis produced $7.5 billion worth of free cash flow, meaning in an average year they produce about $1.5 billion worth of free cash flow. When we divide that by their $87.5 billion total enterprise value, that gives us under a 1.7% average free cash flow to enterprise value yield for the business. On a current basis, Zoetis produced $1.3 billion worth of free cash flow in their most recent fiscal year. When we divide that by their enterprise value, that only gives us about a 1.5% current free cash flow to enterprise value yield. On both a current and an average basis, this is coming in at less than half of the yield of the 10-year treasury, meaning this risk premium doesn't seem to be present in the business at today's valuations. This is an X on metric number 6. Just because this is the case doesn't mean you're going to toss this business out. This is not a buy or sell recommendation of any security. It's not financial advice. You'll want to stick around as we come to a more concrete estimate of Zoetis' fair intrinsic value before giving our rating to the business. But first, we can't forget about our bonus metric. As our bonus, we're looking at Zoetis' dividend profile. Zoetis currently pays a 0.79% dividend yield. Even though this is below the dividend yield of an S&P 500 ETF, we still want to look to see if it's supported by the company's free cash flows. In all 5 of these years, Zoetis has increased their dividends per share. They've hiked their dividend payouts by about 2.5 times throughout this period, so this is pretty strong dividend growth. At the same time, Zoetis has seen their free cash flows decline. However, the business seems to have supported their dividends pretty comfortably in all 5 of these years. While their dividend payout ratio today is higher than it was 5 years ago, the company is able to support their dividends using their cash flows. This is a snapshot of their last 5 years of performance. It's no guarantee for the future, but it seems like Zoetis' dividends are supported and healthy here. Everything we've discussed so far is important, but there's something missing that in my opinion is the main reason to analyze Zoetis, which takes us on to using a discounted cash flow model to come to an estimate of Zoetis' fair intrinsic value. A DCF model is based off the predictability of a company's free cash flows. It's like any model in any discipline, its outputs are sensitive to its inputs. We're starting with an average of Zoetis' free cash flows over their last 3 years, then using historical growth assumptions to project these into the future. It's up to you to do your own homework to see if these are accurate and applicable going forward for Zoetis. If we assume Zoetis grows their average free cash flows at a rate of 7.2% for the next 10 years, then in the 10 years from there that these would grow at 4% annually. If we add in the company's tangible book value, which gives us an estimate of their net worth, and we were seeking a 15% rate of return, which is the rate of return Warren Buffett's looking for from his investments, in addition to his margin of safety requirements, from today's valuations, an estimate of Zoetis' fair intrinsic value is around $33 per share. That's down very significantly from what the company's current stock price is. Keep in mind this is just an estimate based off these assumptions. There are reasons why this may not be accurate. However, Zoetis has had a high degree of business predictability in its past. That's not necessarily a guarantee for the future. That's something that's subject to change. Please be mindful, this analysis is not financial advice. It's not a buy or sell recommendation of any security. Before considering any investment decision, consult with your financial advisor. In just a moment, we'll give our rating to Zoetis, but we have to address something first. What are the qualitative aspects of the business? Starting with the key qualitative points supporting a potential long thesis. Number 1, because the animal health industry lacks large payers like Medicare, single-payer governments, or large insurance companies, Zoetis maintains significant pricing power. Number 2, companion animals are increasingly viewed as family members, drastically increasing owners' willingness to spend on pet healthcare. Number 3, growing interest in probiotics, antibacterial peptides, and immune modulators as alternatives to antibiotics offer many targets for innovation. Then the key points supporting a potential short thesis. Number 1, emerging market customers may be more price sensitive and more open to using generic products. Number 2, lower margin emerging market sales will make up an increasing proportion of company sales, potentially creating a headwind to Zoetis' margins. Number 3, strict regulation or restriction of antibiotic use in animals could harm Zoetis' production animal product sales. There you have it for a balanced perspective of some of the company's key qualitative aspects. Now it's time to give our rating. In analyzing Zoetis, stock ticker ZTS, we learned the company produces average returns on capital of about 22% annually in their last 5 years. They've grown their revenues and their net incomes, however their free cash flows are down. At the same time, the company's bought back a slight amount of their shares outstanding. It looks like the company's able to support their debt loads on both a current and an average basis of their free cash flows, then on both a current and an average basis of their free cash flow to enterprise value yields. Those were coming in at less than half of the yield of the 10-year treasury, not offering that risk premium we'd be seeking. Looking at their dividend profile, Zoetis has grown their dividends in all 5 of the last years. They've experienced very strong dividend growth. They've supported their dividend payouts using their free cash flows in all of these years. However, their dividend payout ratio has increased over this time. Combining the factors of our analysis, Zoetis looks like a moderate candidate for further research. While the company has strong tailwinds, when we performed our discounted cash flow analysis, if you've done the work and you believe those historical growth assumptions, from today's valuations of Zoetis, it looks like an estimate of their fair intrinsic value is only around $33 per share. That's down very significantly from their current stock price. The company was last at those levels in August of 2014. It's worth reiterating this analysis is not financial advice. If you enjoyed today's video, please be sure to like the video, subscribe to the channel for more stock analysis videos, comment down below what business you want me to take a look at next time. Thanks for learning about Zoetis with me, and have a great day.